While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, we're coming to you on a historic day, Britain's Independence Day. For those who haven't heard, and I'm sure 99% of the listeners have, Britain voted to leave the euro, and markets have responded amazingly. Bonds to stocks to gold and silver, currencies, everything has massive volatility. Right now, I mean, where should we start, Eric? Should we start with gold? Gold was up in dollar terms over $100 at one point on the news. High, I think it was about $13.63, ticked the high. It consolidated throughout the day here on Friday. The big news with gold is it closed the COMEX well above $13.08, which in technical terms means a new bull market is underway as it is closed, not even daily close, but a weekly close. It's a new higher high than the 2015 high, so that's big news for gold. Silver up. Last night it was trading well over $18 momentarily. Can consolidate around the 1780 level here today. We go to stocks. Financial stocks like Deutsche Bank and Credit Suisse are both down nearly 20%. And then big moves in currencies. I mean, at one point, the pound was down, I think I saw 10.5%. I mean, typically in a currency, 100 basis points move is a big move in a currency. And we're talking 10.5% against the dollar. In pound terms, gold was up 22% at one point I saw. I think it's backed off a little bit to around 14 or 15%. But just historic moves and probably the most important and significant event in the financial markets in the past decade, Eric.
Yeah, and the pound sterling's move is the biggest, I think, ever in record on a single day. Gold is interesting. I mean, if we look at it now, after its big move, I mean, with that 100-plus spike, we have been able to maintain about two-thirds of that, and it's at 1320, give or take. And it leaped off of the 1260, 1265 area, and that we are now rather unusually somewhat trading sideways for the last third session of the COMEX normal hour trading session, and then in the after hours, and here we are on Friday. I mean, normally you would expect to see continued volatility going in, and all of a sudden we have what is a short-term kind of equilibrium in the market expressing itself in the price that's obviously being shaped in part by capping efforts. The initial spike this morning was partially driven by short covering because a lot of people are on the wrong side of that, of course. And all of a sudden now we are being able to sit going into the weekend with the market stabilized. And that's really weird. I mean, in all of my experience in watching markets after big events like this, to find equilibrium this quickly is another example of the cartel probably being on the other side of what would obviously be continued accumulation. But in any event, next week is going to bring more fireworks. There's a lot of funds that are probably on the wrong side of FX trades, particularly with bets that probably were just flat-out directional bets by a lot of global macro hedge fund guys that like to, shoot from the hip and make big bets and whatnot. And with the number of funds that are out there, it's simply just an issue of mathematics. I mean, there's a certain percentage of those guys that are going to blow up today. And next week, as the markets move forward, we're beginning to see, margin calls on those players, and eventually by, maybe Wednesday or something, we're going to start, or Tuesday even, we're going to start hearing about funds that are stuck and that are, in a bad way when it comes to their book, and they're going to end up being, catalysts for further downside. So that's an aspect to what we should look for next week. as well as what I think is one of the lesser obvious unintended consequences to this whole sequence of events, and that is the British government has basically got a lame duck government, and there is, more importantly, no clear leadership that's going to fill the void, because Cameron announced that he's going to resign in 3 months, and the Labour Party and the
Should
Tories...
we make a call that Nigel's going to be the next Prime Minister, Eric?
That would be just awesome if that were to happen, but it's not going to happen, at least in the near term, because he's a member of UKIP and the UK Independence Party. I mean, for Pete's sake, the name of the party in and of itself is somewhat of a moot point at this point. So what the heck does that mean in terms of his career? I mean, yeah, he'll still be in the Parliament for a while, but then what? Frankly, I wouldn't be surprised if about 6 months from now we hear that Nigel Farage is positioning himself somehow, some way, to have a domestic political role. And I'm not sure exactly how that would work. I'd have to give that some thought, because I'm not sure how that would transition in terms of, what happens to his role at UKIP, what happens to UKIP in and of itself, all of those moving parts that I haven't had the time to ruminate over and figure out. But that's definitely an interesting speculation. But, again, thinking about how we look at this in terms of what's important for near-term market action and then beyond as well, from both a market and political perspective, that whole absence of leadership in the British government is a really big, big deal. And I think that that's going to just marinate in people's minds over the weekend and end up asserting itself in terms of further turmoil next week when it comes to what the markets end up doing, because it'll send a lot of market participants into further fear that they're not going to have any confidence that the UK is going to be able to pull itself out. And then there's going to be a huge amount of chatter over this weekend in the media coming from all of the various meetings that have been going on and will be going on in terms of how to deal with, what does Brexit mean? How do you actually go through the process of Brexit? Cameron at some point is going to be doing the Rule 50 announcement and setting up that process that begins the Brexit mechanics per, the route at which they can proceed with a legal Brexit. But it's a really complicated negotiation, and the leaders in the German camp and the French camp, they're not going to see eye to eye with what ends up being the negotiating positions for Britain, and it'll take a lot of time to actually get all of that stuff ironed out. And over the course of the next couple of weeks to couple of months, that's going to probably considerably add to the volatility that we're going to be seeing, and so I'd also throw that into the mix of the things that we can put up on our to-watch list, be on the lookout for indications that that's in fact unfolding, because if we do see that, we're going to see a heck of a lot more market turmoil as a result.
Yeah, speaking of the market turmoil, and as we go into this weekend, as Eric mentioned, it's been quite interesting, the trading action today. There really hasn't been a lot of follow-on action or panic either to the upside or to the downside, and whether that be just due to the fact of the Plunge protection team and supplying liquidity to the market to absorb selling, or if it's a combination of that and short covering, and everybody's just so stunned that they're stepping back and analyzing the situation before they make new positions. What do you think, Eric, here over the weekend as everybody gets a couple of days here to digest it? What we saw here today, we saw currencies make massive moves. There's bonds that are going to be significantly affected, interest rate swaps that are significantly affected. The financial sector has been hit hard. What are we looking at come Monday morning? I mean, to me, my gut tells me we may see more chaos Monday morning than we've seen today on Friday, as everybody's has a chance to step back and think about it and then says, holy crap. And what am I going to do now to protect myself? And
Right.
whether it's gold, bonds, holy crap, everything I was thinking before, I need to shift that sentiment, that thinking. I mean, are we looking at the chance for a bloodbath on Monday, or do you think that's over here with all the moves we saw here on Friday?
I'm going to answer your question in a slightly different way to address the fact that, forecasting for that kind of a short-term window is pretty much impossible. I mean, frankly, it's not possible to know what will happen first when it comes to the opposing forces, the fear and the individual investor actors bailing versus the central bankers and all of their compatriots pushing in liquidity. So what happens on Monday is going to not necessarily be as important as what happens in the next 3 trading days. And when it comes to the next 3 trading days, I do think that either Monday or Tuesday, we're going to see a pretty big downdraft. The most likely scenario, based on the kind of things that we've seen in previous reactions to big trading days and catalytic events, is that, Monday is probably going to see a downdraft first, and then you'd likely see, the address of that when it comes to the swap lines from the Fed dumping tons of money into the ECB, where, and to explain that to people too, because we always have new listeners, the Federal Reserve can print up digital credit, call up Mario over at the ECB, and Janet says, hey, buddy, here's some U.S. dollars. Give us a bunch of equal-valued euros in exchange, and it's a neutral, quote-unquote, transaction, not even reported on the friggin' balance sheets of both of these central banks because they hide this garbage. We know this for a fact because as part of the partial audit that was achieved by Ron Paul's long-time efforts to get an audit, it was revealed that $16.9 trillion worth of backstop swaps, etc., were executed in the 2009 timeframe, give or take, a little bit in 2008 probably. Frankly, I don't remember the exact time frame, but it was certainly in address of the core of the crash of 2008 and beyond. And that's going on right now. I can't prove that, but I think that is going on now, based on the very public statements from leaders of our central banks. The ECB, the Bank of Japan was out making statements in the early morning hours about being able to defend the yen, not doing a very good job of that, but preventing it from falling down and creating FX currency turmoil, etc. So these swaps and these efforts, the swaps are probably the main tool, in fact, that the central banks are using as we speak and will be using on Monday to address the counter force of a whole bunch of people wanting to bail out because they're scared and maybe even they're stuck because they're getting margin calls. And so the most likely scenario would be that, Monday we'd see European markets down first pretty hard and then carry over into the U.S. market, and then at some point some kind of like resuscitation based on powers that be actions, the plunge protection team, etc. But the real important dynamics going on is not the shorter term, but in fact, even just on balance next week, I think overall next week's trading is going to see markets, when we record this time next Friday, they're going to be down. Precious metals will be up. The pound sterling will be down further. And maybe one of the things that people should take a very careful look at over the course of the next couple of trading days is what happens to European banks, because that'll tell the degree to which the powers that be are being successful in stemming the blood leading. The banks are what the powers that be are the most concerned about because of the systemic risk that they represent in terms of spillover into blowing up or imploding the financial market, depending on how they, the whole sequence of events happens. And I noticed today it's actually kind of interesting. If you look at, for example, the ADRs of Deutsche Bank. Deutsche Bank is trading above where it was in that low that it hit back on 14 June, which is kind of amazing when you think about it, considering what just happened over the last 24 hours. That is an indication, though I cannot prove this, but it is an indication of the powers that be in there trying to catch these falling knives and supporting the market. So the next week's going to be darn interesting. I think we are going to trend downward because we are in a kind of asset deflating cycle from the shock of Brexit and upside down portfolio managers dealing with it and just outright fear, and then the ramifications of the financial sector within the City of London basically getting a big kick in the gut. We see lots of stories about how it's rumored that Morgan Stanley is going to go ship 2,000 employee jobs over to Dublin or to Frankfurt so as to be in the European-centric financial world, as opposed to City of London and it being somewhat removed from the apex that it has enjoyed given Brexit and all of the fears and whatnot that the establishment were saying with respect to the City of London and all of those financial players. I mean, there's some truth to that. They definitely will take a significant hit. So anyway, next week it's going to be pretty damn volatile, and we have the makings of the official establishment sector, the plunge protection team, the central banks, on and on, setting up to try to catch the markets. And I don't think they're going to be able to stabilize the markets before we get a lot lower. But I'll also say that I don't think that this looks, based on what I see in terms of dynamics in trading for lots of different segments, as well as what I just noted about the banks and so forth, and the fact that we have bounced back and there's this kind of weird quiescence. I think that the powers that be actually have been able to calm things down a little bit. So I don't think this is setting up for like October 1987 style crash on a Monday, but we're going a lot lower.
Let's take a couple minutes and talk about gold and silver, because everybody wants to know what are the implications to gold and silver. What are gold and silver prices going to do now as a result in this? And we touched on a little bit that, technically speaking, a new gold bull market has been confirmed today with a weekly close over 1308. Last week, the title of our show was 1300 gold, 3 taps and out. And what we saw last night, the third tap wasn't even a tap. It was just a slice through 1300. So going forward, it certainly looks to me like that 1300 level and really around the 1308, 1310 level should hold. You might test it once or twice, but I would expect it to move off of that and start climbing higher towards 1400 quite quickly. What's your take, Eric?
Yeah, I'd agree with that. In fact, 3 taps, forget that. It was more like a Muhammad Ali left jab KO punch. I mean, yeah, okay, it's theoretically possible that the cartel will be able to orchestrate a level of protective action such that they're getting gold under 1300 for whatever, a week. I mean, but let's be serious. The macroeconomic and geopolitical map that we're now looking at on a global stage has significantly changed, and this whole devolution of the Euro project and the European Union at that, because there's going to be separatist efforts springing up all over the place. I mean, I've counted already 5 of leaders around Italy and France and Spain and so forth that are speaking of, and even Scotland talking about rebooting their effort to have Scottish independence from the EU, despite the fact that Scotland overwhelmingly voted to remain. I mean, if memory serves, I think they voted like 71% to remain, which is pretty amazing. So, yeah, I don't think we're going to likely see gold under 1300 for anything other than like a blip of time. And we already were setting up to, by the end of this year, see 1500 and maybe 1400 by next month, 6 weeks out. I was speaking about it on our last show, I believe, if memory serves, that the end of July is a very realistic target for gold getting towards that 1400, never mind Brexit, given just the generic economic downturn that's going on worldwide and all of the other bullish factors for precious metals. So this Brexit is just gasoline being thrown on the fire. And I think we're going to see a lot higher prices in gold. And at least the nice thing about Brexit is that it's bringing in a lot more people to recognize that we are in this longer-term bull market. But it's still very early days. And the percentage of ownership for gold is pretty, non-existent in financial world. In terms of the conventional financial world, it's still at about 1% of assets. And a lot of people, because of Brexit, are going to be reevaluating their assumptions.
We've warned for probably several years, Eric. I mean, an event like this, you can have 0.5% to 1% of people wake up to an asset class of gold and silver, something like this, to shock the system. Now, I'm not saying that's going to happen overnight, but it certainly is feasible to contemplate looking forward that a percentage of the population could wake up to gold as the scenario plays out. And if that happens, there's just simply not enough bullion available.
Yeah.
All right. Well, any last thoughts, Eric, before we wrap the show, of what our listeners and readers should keep an eye out for as we open the Globex Sunday night and onto Monday?
I would say pay really close attention to European banks. There's even a bank index that you can look at, but watch the share actions of Deutsche Bank and Credit Suisse, and see if you can pull up quotes for Bank Santander, because they have a lot of exposure in weak debt in Brazil, and their loan book is pretty weak. And Italian banks, these are the kind of places where you're going to get signals in terms of where are the weakest links in the overall financial market, and what's happening to the push and pull of the powers that be trying to resuscitate those assets and preventing them from sliding down the toilet, versus the people that are shorting the heck out of them because they're wanting to use them as an instrument to profit as this whole unraveling happens. So that is going to be pretty important data that traders and just people following along can look towards to get a pretty decent signal as to what's going on with the rest of the market and who is doing what. The battle between the powers that be trying to save the system versus all of the other actors doing their thing for their reasons.
All right. Well, take advantage of 48-hour pause in the markets. I know I am. I'm looking forward to a little bit of a pause. It's been a long 18 hours. Pretty packed.
Yeah, and we'll have a lot more coverage of what's going on later. Maybe Sunday I'll put something out and I'll publish it on the News Doctors. There's so much going on that it just frankly takes a lot of time to assimilate and put it into a coherent package where dots are connected and it actually makes sense. And amusingly enough, when Doc called me and said, "Hey, are you ready to do the show?" I'm like, "Nah, can we have 10, 20 minutes more?" I mean, it's just astounding how quickly things have changed. But we'll put more analysis out over the weekend. And folks are also welcome to send us questions. I mean, you can reach me via my email account or Facebook.
All right, so we'll keep you updated over the weekend. We also released Jim Willey's thoughts, recorded this morning a few moments ago also. So plenty to read on Brexit over the weekend. And as the situation continues to develop over the weekend and into next week, we'll keep an eye on the markets. So for the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.